In 2021, you did say that inflation was transitory. Do you regret saying that now?
I regret saying it was transitory.
Meanwhile, American consumers are still spending, and that's keeping U.S. economic growth on track.
Uncertainty around the path of inflation remains high. We will carefully assess and manage the risk of higher and more persistent inflation. We'll make sure that this one-time increase in prices does not become an ongoing inflation problem.
There's a financial riddle that breaks every economics textbook. Japan printed money for 30 straight years. We're talking about creating trillions of yen out of thin air and got zero inflation. Meanwhile, the United States has been quietly stoking inflation for decades, culminating in the explosion that we saw during the COVID years. How is that even possible? And more importantly, what does this tell us about what our own institutions have been hiding from us about how money actually works? By the end of this video, you're going to understand one of the biggest secrets in global finance and why everything you've been told about inflation might be completely wrong. My name is Elizabeth Ann Stewart, and you are watching Geopolitics and Money. Follow the money, decode the world. Let's start with Japan because their story is absolutely wild. Picture this. It's 1991 and Japan's economy has just crashed harder than a house of cards. Real estate prices collapsed by 70%. The stock index fell from nearly 40,000 to under 15,000. Millions of people saw their life savings evaporated overnight. Now, in any normal country, the central bank would lower interest rates to stimulate the economy, right? That's economics 101. But Japan took this to an extreme that would make your head spin. They didn't just lower rates, they drove them to zero, then below zero. Then they started creating money and buying everything in sight. We're not talking about small amounts here. The Bank of Japan's balance sheet grew from roughly 100 trillion yen in the year 2000 to over 700 trillion yen today. That's like the Federal Reserve growing from 6 trillion to 42 trillion. They were literally creating more money than some entire country's GDP. And here's the kicker. Inflation stayed at basically zero the entire time. In fact, Japan struggled with deflation, where prices were actually falling year after year. So how did they pull this off? And why did the United States go down a completely different path that led to decades of creeping inflation, culminating in what we have right now? The answer is going to reveal something that central banks really don't want you to understand about how inflation actually works. Here's what was really happening in Japan, and this is where it gets fascinating. Now, most economists will tell you Japan had what they call a liquidity trap. But Professor Richard Warner, who actually worked at the Bank of Japan and wrote The Princes of the Yen, revealed something much more interesting. Warner discovered that Japan's money printing wasn't actually reaching the real economy. And this wasn't by accident, it was by design. When the Bank of Japan bought government bonds from the bank, those banks didn't turn around and lend that money to businesses and consumers. They just kept it as excess reserves. But here's Warner's key insight. Banks create money when they make loans, not when central banks give them reserves. If banks aren't lending to productive businesses, all of that quantitative easing is just inflating asset prices, not consumer prices. Think about it like this. Imagine you're trying to fill a swimming pool, but instead of connecting the hose to the pool, you're just spraying water into the air above it. Most of the water evaporates before it even reaches the pool. That was Japan's monetary policy. Warner argues this was actually intentional. The Bank of Japan, influenced, of course, by US advisors, wanted to keep Japan economically subdued after it became too competitive in the 1980s. As Warner puts it, the central bank can create a recession by restricting credit creation. and it can create a recovery by expanding it. Here's another crucial factor that Werner identified. Japan's money went into non-productive uses: government bonds, real estate, speculation, and stock buybacks. It didn't fund new factories, new businesses, or productivity improvements that would drive real economic growth. The Japanese people, on the other hand, scarred by the 1991 crash, became obsessed with saving. Cultural factors played a huge role here. In Japanese society, debt is seen as shameful and saving is seen as virtuous. So even when money was cheap, people didn't borrow to spend, which will be very important as we talk about the United States later. Now, you might be thinking, okay, so Japan's central bank kept money out of the real economy through clever financial engineering. But what about America? Surely we took a different approach. And you'd absolutely be right. The United States took the exact opposite path, and the results have been building for decades. Let's talk about what really happened in America, because the story doesn't start with COVID. It starts in 1971. That's when President Nixon did something that changed everything. We all know he ended the gold standard. Suddenly, the dollar wasn't backed by anything except for the government's promise. The Federal Reserve could now create as much money as it wanted with no physical constraints. And create money they did. But unlike Japan, America's newly created money went straight into the real economy through a bunch of channels. First came the 1970s oil shock and the birth of persistent inflation. Then the Volcker shock of the early 1980s, where Fed Chairman Paul Volcker crushed inflation by raising interest rates to 20%. But notice, he didn't eliminate the Fed's ability to create money. He just temporarily restricted it. The real acceleration started in the 1990s under Alan Greenspan. Every time there was a crisis, savings and loan crisis, the dot-com crash, 9/11, the Fed's response was the same: lower interest rates and create more money. But here's the key difference from Japan. The money was actively encouraged to flow into the real economy through consumer lending. Americans were told that debt was good, that spending drove growth, and that home prices always go up. We built an entire culture around consumption financed by cheap credit. Credit cards, home equity loans, auto loans. The financial system was designed to get newly created money into people's hands so they'd spend it. By the 2000s, we had what economist Michael Hudson calls a debt-based economy. GDP growth was increasingly dependent on people borrowing money to buy things. Housing became financialized. Healthcare became financialized, and education became financialized, having to get student loans to go to university. Everything became a vehicle for debt creation and money circulation. Then came 2008, and instead of letting the system reset, the government doubled down. Quantitative easing, zero interest rates, and a new innovation: buying mortgage-backed securities directly. The Fed was now directly propping up asset prices while keeping borrowing costs near zero. Here's where the story gets really interesting, because by 2010, we had already set up all of the conditions for serious inflation. We just hadn't pulled the trigger yet. Think about what had happened by then. We'd spent 4 decades building a consumption-based economy. We'd trained Americans to see debt as normal. We'd created financial systems that pushed newly created money directly into spending. And we established the precedent that every crisis would be met with more money creation. The only thing missing was a big enough shock to justify truly massive money printing. COVID brought that shock. But here's what most people miss. The inflation we saw in 2021 to 2024 wasn't just about COVID policies. It was the inevitable result of 50 years of monetary policy choices that prioritized growth over price stability. When the pandemic hit in March of 2020, the Federal Reserve and the US government didn't just print money, they fire-hosed it directly into people's bank accounts using all the infrastructure they'd built over decades. $5 trillion in fiscal spending and another $4 trillion in Fed money creation in just 2 years. Stimulus checks enhanced unemployment benefits, Paycheck Protection Program loans that became grants, student loan payment freezes, eviction moratoriums. The government essentially paid people, and especially companies, to not work while giving them free money to spend. And here's where Janet Yellen comes in with the transitory narrative. Throughout 2021, as inflation started creeping up from 2 to 4 to 6 over the years, Yellen kept insisting it was transitory or temporary. She used that word a dozen times in public speeches, congressional testimonies. Now let me be clear about what transitory really meant, because this is one of the biggest gaslighting operations in modern economic history. Yellen and the Fed knew that inflation was going to spike. They had internal models showing exactly what would happen when you shock trillions of dollars into an economy with a broken supply chain. But they had a problem. If they admitted inflation was going to be serious, markets would panic and the recovery would slow or collapse. Transitory became their magic word. When inflation hit 4%, they said it was transitory. When it hit 6%, still transitory. When it reached 9% in June of 2022, they finally admitted maybe it wasn't so transitory after all. Internal Fed documents released later showed that their own economists were projecting persistent inflation as early as April of 2021. They knew and they lied about it because they were terrified of unanchored inflation expectations. So here's the fundamental difference between Japan and America and why their money printing had the opposite effects. Japan, as Werner documented, kept newly created money trapped in the financial system. Banks held excess reserves, bought government bonds, and funded non-productive speculation. The money never reached ordinary people in quantities that would drive consumer spending. America did the exact opposite. America built a machine designed to get newly created money into people's hands as quickly as possible. We're looking at credit cards, mortgages, student loans, auto loans. Every form of consumer debt became a transmission mechanism for monetary expansion. Japan's demographic decline meant fewer people wanting to buy things. America's growing population and culture of consumption meant more people competing for goods and services. Japan's cultural preferences for saving acted as a natural brake on inflation. America's cultural preference for spending and debt-financed consumption acted as an accelerator. The result? Japan got 30 years of deflation despite massive money creation. America got 50 years of steadily building inflationary pressure that finally exploded during the COVID years. Here's what this whole story really reveals. Inflation isn't just about how much money you create. It's about where that money goes and what people do with it. Japan's central bank, as Werner showed us, could create trillions without inflation because they kept that money away from consumers. America's central banks created inflation because they built a system specifically designed to get money into people's hands so that they'd spend it. The transitory lie was just the final insult. Our institutions knew exactly what they were doing, and they did it anyway. And then they lied about the consequences. So the next time you hear about unexpected inflation or transitory price increases, remember this story. It's not about economic theory or mysterious market forces. It's about institutional choices and where that money actually flows. The real question isn't whether central banks can create money without inflation. Japan proved that they can. The real question is whether they want to. And in America's case, the answer has been a clear no for 50 years. What do you think? Was America's inflation inevitable given our economic structure, or could we have followed Japan's path? Let me know in the comments. And if you want more deep dives into the stories our institutions don't want you to understand, make sure to subscribe.